Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Sesen Bio stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Sesen Bio is a late-stage cancer drug company. It's focused on testing drugs on patients and tracking the effectiveness and risks of the drugs. If the testing proves successful, then the company will apply for FDA approval, and if approved, it would then market and sell the drug. The company is headquartered in Cambridge, Massachusetts, and was founded in 2008. It went public in 2014 and trades on the Nasdaq and Deutsche Börse. There are some drug companies involved in every stage of the drug-making process. Sesen is only late stage. Let me clarify what the stages mean. The first step is the preclinical phase. This is when you test the drug on non-humans. You're testing it for effectiveness, toxicity, and also pharmacokinetic information. Pharmacokinetic is a study of how the drug moves through the body. Once the drug passes this phase, then it goes to phase 0. This is when the company can start testing on humans, up to 10 people. The main focus is on how the drug moves through the human body. Then phase 1, where you can test more people, 20 to 100 people. This phase is focused on dose ranging. Dose ranging is where different doses are tested against each other to see which dose works best and is least harmful. About 70% of drugs pass this phase. Now Sesen picks up at phase 2. Phase 2 and 3 are pretty similar. The main difference is the number of people they can test. These two phases are used to assess the effectiveness and side effects of the drugs. And about 25 to 30% of drugs pass phase 3. Phase 4 is when the company gets FDA approval and they can start selling the drug. The drug that's furthest in the process at this company is Vicinium. Vicinium is currently in the process of getting FDA approval. Vicinium will help treat NMIBC, which stands for non-muscle invasive bladder cancer. It is a targeted fusion protein designed to overcome the effectiveness and safety challenges inherent in existing antibody drugs. The FDA is granting a priority review, which means it will have an answer within 6 months, as opposed to the usual 10 months. During the study, 40% of patients had a complete response at 3 months, 17% at 12 months, and 11% at 18 months. Regarding safety, 96% of all adverse events were grade 1 or grade 2. Only 4% were grade 3 through 5, and 3% of the people had to discontinue the drug due to adverse events. Just to clarify what that means, grade 1 adverse events are mild, grade 2 are moderate, grade 3 is severe, grade 4 is life-threatening, and grade 5 is death. Just a few months ago in March, Merck got FDA approval for a similar drug called Keytruda. That's a really good sign for this company, since the test results for Vicinium and Keytruda were fairly similar. As you can see, the 3-month response rate was almost identical. Keytruda did have a better 12-month and 18-month response rate. Regarding adverse events, 13% of Keytruda patients were grades 3 through 5, while only 4% Vicinium. And 10% of the Keytruda patients had to stop taking the drug, only 3% of Vicinium. So this is really good news for Sesen. So since the FDA approved Keytruda, it seems like Vicinium should have a good shot. Let's get started with the model. This is a small cap company, 738 million market cap. They're trading at $4.26 a share, and they have 173 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have negative free cash flow each year since they're not bringing in much revenue. Net income is the profit or loss on the income statement. It's revenue minus expenses, which is also negative every year. Revenue is the sales for the company, and that was nothing in 18 and 19. They did have their first revenue in 2020 of 11 million. It's 16 million in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. So all the revenue is from a licensing agreement that's with a company that's going to manufacture and sell Vicinium. So it is good they're receiving revenue before they get FDA approval. And of course, if they get FDA approval, the revenue will go up dramatically. Below revenue is our operating expenses, and a majority of this is research and development. The rest is the payroll for their staff. Then below that is operating income, which is negative every year. They have no debt, so they have no interest payment on their debt. Then below that is other income and expenses, and these dollar amounts are mainly tied to mergers and acquisitions. The bottom line of the income statement is their net income, which of course is negative every year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. And the company has very little capital expenditures, since most of the cost to developing a drug goes to research and development. Operating cash flow minus CapEx gives you your free cash flow. Since they have negative free cash flow each year, they need money from somewhere to run their business. They don't issue any debt, which is good. It's smart not to issue debt, because when you're a young company, the interest payments on the debt are going to be really high because you're not bringing in any revenue. And in order to pay the interest payments on your debt, you'd have to issue more debt, since you don't have enough revenue coming in to pay the interest payments. So they're running their business on capital stock. And the negative of that is it dilutes the shareholders. They issued 58 million in 2018, 30 million, 38 million, then 107 million. Every time a company issues capital stock, that increases the shares outstanding, making your shares less valuable. Let's look at the capital structure. They have $9 million of equity and no debt, so they're 100% equity. The weighted average cost of capital, which is a blend of the cost of debt and cost of equity, since they're all equity, that's the cost of equity, is 8.6%, and that's the discount rate we're going to apply to the future cash flows. We estimated 7 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 7. That's 5.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $3.3 billion. We divide that by 173 million shares. And we get a calculated stock price of $19. They're trading at $4, so they're trading at a 77% discount. It's a strong buy according to the model. So 3 analysts said this company would not turn a profit until 2023, and their profit would be $31 million. What I've noticed is when analysts make these estimates, things usually go wrong. It takes longer to get the FDA process. The company can't get as much financing somewhere, so things get delayed. So I push that out to 2024. So in my model, the first time they'd have positive free cash flow was 2024 at $9 million. Then I grew from there. And the company mentions in one of their reports that Vicinium has the potential to generate $1.4 billion to $3.5 billion of revenue. So I also took that into account when trying to estimate the future free cash flows. Simply Wall Street is higher than me. They're at $25 a share, so they're saying the stock is 83% undervalued. This is the stock price since it started trading. So there was a really big run up right away, and the stock was at its peak of all time. It looks like pretty close to $5. And then it's come all the way down below $1, but there's been a recent run up over $4. It's still trading below its all-time high though. This is a stock price the last 12 months. So like I said earlier, it was trading below $1 at some points here. When the company announced it may get FDA approval, the stock price was really driven up. If they get the approval, I think the stock price will go a lot higher. But if they don't get the approval, the stock will definitely crash. And they have a pretty low beta, 0.82, so the stock is less volatile than the market. The stock has gone up 5x in the past 52 weeks, while the S&P 500 went up 36%. The 52-week low was 66 cents, the high was 437. And the stock is trading above its 50-day and 200-day moving average. Close to 6 million shares are traded each day on this stock. Pretty much all the shares outstanding are on float. When a share's on float, that just means it's available for investors like me and you to purchase. 24% of the shares are held by institutions, and 4.5% of the shares are shorted. This stock is up a lot the past year, 3 years, and 5 years, more than its industry and the market. Except in the past 5 years, the stock is up 80% and the market 126%. So analysts seem to be forecasting the company to grow a lot. They're forecasting their earnings to grow 70%, its industry 15%, and the market 16%. They're expecting their revenue to grow 53%, its industry 14%, and the market 9%. In the past 5 years, their financials are obviously not so good. Their annual earnings decreased 34%, its industry increased 22%, and the market increased 12%. In the past year, their earnings decreased 69%, its industry decreased 8%, and the market increased 21%. If you invested $10,000 when this company IPO'd, you'd be at $3,900 today. That's a 61% loss. The biggest shareholder is Vanguard, 4.15%. They're the largest provider of mutual funds in the entire world. The next biggest is Heights Capital, then Third Rock Ventures, then Renaissance Technology, and then rounding out the list is Schoenfeld Strategic Advisors. Let's look at their financial ratios. The average PE in the market's 32, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income since they don't have much revenue, so we can't look at the PE. They have a really high price to sales ratio of 48. Also a really high price to book of 80. And the way you calculate price to book is stock price over book value per share. To calculate book value per share, it's equity over shares outstanding. Equity is on the balance sheet, it's assets minus liabilities, and they have 9 million of equity, negative 50 million of tangible equity, because they have 59 million of intangible assets on their balance sheet. So it looks like they've been acquiring companies the past few years. They have a negative net income, so they have negative ROE. And they have a ton of current assets on their balance sheet. They can easily cover their current liabilities. The main reason was due to all the capital raises. They have 110 million of cash on their balance sheet. Even though they had negative $40 million of free cash flow in the trailing 12 months, they have over $100 million of working capital. Working capital is current assets minus current liabilities. So it seems like they have a sufficient amount of cash to run their business over the next 12 months without doing another capital raise. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 15 companies in the same industry as Sesen, and if Sesen has a number in red, they're worse than the industry average, and their ratios are really weak because they're not bringing in much revenue and they're so young of a company. So they're red in every single category. So to summarize, I have them trading at a 77% discount, but this is really assuming Vicenium gets FDA approval. If it doesn't, they're going to be in trouble. They do have other drugs in the pipeline, but Vicenium is by far the furthest ahead in the process. This is from a Forbes article talking about late-stage medical companies. The three main risks are regulatory risk. The FDA could make it difficult to get approval. You're really at the mercy of the FDA. Or also there could be a lot of drugs they recently approved or similar drugs they recently approved. It can make it difficult for you to get FDA approval. So there's lots of things that can determine whether the FDA gives the green light. And there's major financing risk with a company like this. They need to constantly spend money. If they can't raise capital or take on debt, they're not going to have the money to do research and development to move the drugs forward in the approval process. And there's liquidity risk. Even if they do get FDA approval, then the company has to market and sell the drug. Even though they're outsourcing that doesn't mean the company they're outsourcing it to will be successful. The ideal situation is they get acquired by a bigger company, but obviously that depends a lot on whether the bigger company has the funds to do it or is willing to do it. So it's going to be really interesting to see how this company develops over time. I rank their free cash flow as 1 out of 10, their revenue 3 out of 10, and their ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.